Today, we're talking about taxes when you sell your business. And the right tax strategy can mean the difference between maximizing your payout or leaving money on the table. My guest today, Jason McAdamis, is a partner at the firm Rubin Brown, and he's a tax expert who helps business owners navigate the complexities of an exit. We'll break down the key tax strategies, the reality of selling to private equity, separating fact from fiction, and how to structure your deal for the best tax advantaged outcome. Jason, welcome. I just want to start with an overview today. Where should businesses start when they think about selling their business from a tax perspective?
I would say typically we say 3 to 5 years out. Sometimes it's kind of a spur of the moment decision, and you might say, I'm a year out, and that's fine. You just got to get your ducks in order quickly if that's the case.
Yeah. What kinds of things do they need to be thinking about as far as, I know we talked about like documentation and how much of a workload should they expect? How do you get them started?
Well, it depends on where you're starting from. I would say, some businesses are pretty buttoned up. Others have a lot of work to do. And you got to get the right people in place to help you do that. I would say the biggest thing, and I'm going to speak from financial and tax perspective, since that's my area of expertise. You want to anticipate what questions a prospective buyer will ask. And we focus on a couple of things, primarily quality of earnings, which means like, is my net income what I say it is? Because inevitably your net income or a derivation of that is going to drive your multiple, which is how much somebody's going to be willing to pay for your business. So I would say, first of all, have clean books and records. If you don't have clean books and records, there's lots of folks out there who can help you do that. I would say don't commingle business and personal expenses. And if you have, that's fine. You just got to be able to unwind it. And I would say, I'd highly recommend a sell-side due diligence process where you can have somebody on your side in advance of a deal to identify a lot of issues that might come up on a buy-side diligence project. And if you know what those issues are going to be, anticipate and kind of mitigate them in advance, you're in a much stronger negotiating position.
Can you talk a little bit about like getting the books in order? I mean, there's the differences between having a bookkeeper, maybe your CPA who's been helping you stay on track during business. And then does that CPA help you with the business transaction? Do you need a different type of CPA? Talk about the roles of that a little bit.
Well, that's a great question. I mean, I think your legacy CPA is going to be the one that knows your numbers the best. And they are, regardless of who you decide to help you in the deal process, are going to be integral to getting you there because they know the numbers. But I think the question you want to ask is, do they do these kinds of deals very often? I mean, it's your life's work. There's a lot of money on the line, and you want to make sure that you're not in a compromised negotiating position. And I would say, CPAs in general, and most professionals for that matter, are pretty honest and don't want to be operating outside of their comfort zone. So I would say just ask, hey, are you comfortable representing me on this? Do you do these deals often? What do you see? You can pressure test their skill set a little bit, but I would say generally take their word for it.
So I have found as a business owner myself that a tax person is worth their weight in gold. And I understand, and I want to clarify with you that if you think about, you mentioned planning 3 to 5 years ahead of time. My understanding is the earlier you can plan, really the more vehicles or options you have for saving on the back end. Can you speak to that a little bit?
Yeah, I mean, there's a lot of things timing wise that you can do from a tax planning perspective, pre-transaction restructuring, things of that nature, to put yourself in a better position to sell in a position that's going to benefit you. I mean, there's multiple ways to skin a cat, right? I mean, there's different kinds of deal structures. Some are more buyer friendly, some are more seller friendly. And to kind of have those discussions in advance and know where they lie and what you can do to maximize your potential profit from a after-tax cash flow perspective, the better off you'll be.
How would you, as a business owner, would you want your CPA advisor, your tax advisor working with your attorney in some of those different kinds of trusts you can use and different vehicles that maybe get into some of the estate planning and things? How much knowledge would you want from your CPA as a business owner to know about that and to work with an attorney in that regard?
Well, I mean, I think everybody these days specializes, right? I mean, you've got certain folks that profess to know everything, and that's great. But I mean, I think you touched on 2 points. You touched on mergers and acquisitions expertise, which is a big part of it, and also estate planning. So let's start with the mergers and acquisitions. There are a whole host of things that are very specific to mergers and acquisitions transactions that a lay CPA or a lay attorney might not have. I mean, I think one thing we see often is people going to sell a business will utilize their, historic CPA and or their general business attorney in an M&A context. And that might work sometimes, depending on the sophistication of the issues and deals involved. But I think what my recommendation would be to certainly get people that do this on a day in, day out basis. I mean, this is your life's work. Again, presumably a lot of money on the line, and you want to make sure you're being handled correctly and to your benefit. And I mean, I've seen numerous times where somebody that maybe doesn't know their way around mergers and acquisitions transactions as well can either slow a deal or, in a worst case, put you in a compromised negotiating position where you kind of get taken advantage of on an exit. So that's the M&A side. And you also mentioned estate planning, which is also key. I mean, you're going to be coming into hopefully a sizable windfall, probably a game changer for you, and you want to make sure you're positioned to make the most of that. Now, full caveat, I am not an estate CPA. I know lots of people that are and can make a referral, but there are lots of strategies there with trusts and different mechanisms to plan in advance so that perhaps all or a portion of the proceeds don't hit your estate, which is the goal. But that's another topic for another day.
Right. Well, and indicates the specialty, right? That you mentioned that there's a specialist for everyone. So let's bring it back to your specialty. We talked earlier about some of the vehicles that business owners can use. I'm going to be over my skis here, but you talked about the 1202, and I'll let you take it where it makes most sense for owner selling. But talk about the tax vehicles.
Well, I think there's lots of ways you can go with it, but let's start with the basics. There's the basics of a business sale. There's two ways to do it. There's an asset sale or there's a stock sale. And a stock sale is going to be the most seller friendly because you get, proceeds less whatever you paid for it. That's called your basis, is capital gain. And capital gains are taxed at a favorable rate, generally 15 to 20%, depending on your tax bracket. Selling assets is generally much more buyer friendly. Reason why is the buyer does then not step into your historic liabilities, legal, tax, or otherwise, and buyer usually gets a step up in the basis of the assets, which then they can depreciate or amortize over time. So it's kind of a tax shelter for the buyer. Downside is in an asset sale, you're going to be subject to ordinary income recapture on, for example, prior depreciation taken, prior amortization taken. If you've got cash basis receivables that are monetized on a deal, those are going to be subject to ordinary income. And the tax differential between an asset and a stock sale then can be pretty substantial. Now, sometimes you'll be in a negotiating position to say to the buyer, well, this is going to cost me X dollars more, will you help me out here and pay me extra? That can happen. Other times they're going to say, well, enterprise value is what it is, take it or leave it. And it kind of depends on the dynamics of the buy-sell relationship. So again, back to negotiation, it's going to help to have people in your court that know where you stand in a negotiation process can kind of monitor it real time and keep you in the know with where the deal is currently and what's going to be best for your interests.
Do you have an example of a client or a story where they were maybe headed down the wrong path, like looking at these assets, where you were able to sort of step in and give them some guidance and keep them, from really having some regrets about selling where they left money on the table or paid more taxes than they meant to?
I would say, I hate to say I'm perfect because I'm not. I mean, generally
we
speaking,
can put it out there.
we're usually well advised in advance of, where the basis lie, what's going to be more advantageous. Frankly, it's usually driven by the buyer. The buyer generally has the better negotiating power because they got the money, right?
Yeah.
And they dictate the terms. They've got their team of advisors and attorneys, et cetera. I think you just kind of have to play it by ear. I mean, frankly, and we can certainly advise if there's anything in there that's egregious, that you should push back on to do that. But there's not always an option. I mean, we can help you analyze the tax consequences of what of the hand you're dealt, basically, but not always a whole lot of power to change that.
Yeah.
I would say in practice, I've not usually seen buyers that are just out to get you, so to speak. I mean, they want to close the deal and they know that there's deal killers in anything. Yeah. So they might have an initial volley of a negotiating position, and then that's why you have your CPA and attorney in place to kind of negotiate as you go.
Do you think, do sellers typically have when they come into the deal or when they're talking to you or your experience, do they feel like the buying process is going to be adversarial, or do they come in with optimism as well? Like the buyers are like, let's get the deal done. Are the sellers like, how are you going to take advantage of me? Or are they also just kind of coming to the table?
It runs the gamut, right? I mean, I
Yeah.
think if you're to the point where you want to sell your business, I would say cautious optimism is a way to go about it. I mean,
Mm-hmm.
don't assume the worst, but go into it eyes wide open to,
Mm-hmm.
negotiate for your position. But I don't think, again, most buyers aren't out there to get you. I mean, they want to close a deal and they know you're going to be well advised. And on that basis, they're going to try to get to the finish line as quick as possible. There might be some pressure to close quickly, but
Yeah.
there's not going to be,
A gotcha.
big gotcha moment
Yeah.
because
Yeah.
they know everybody's going to know what they're doing if you're well
Right.
advised. So
Right. So let's dive into some of the different ways that the buyers can come to the table. And we talked a little bit about maybe just diving in a little bit to the private equity boogeyman or like the bad guys coming in. And one of the things that I found interesting is that's really not, and to your point that you just made, it's not really the case. So just talk about the different ways, different buyers that come to the table and maybe the pros and cons, just from a general selling point, but also if there's any tax advantages too.
I definitely want to get there, but I think I do want to touch back on Section 1202.
Oh, great.
I
Yeah,
think
perfect.
one of the things, I generally tell my clients there's no silver bullets. There's an existing set of facts, and we can help you make the most of those facts. But I'd say one silver bullet, if you want to call it that, in the tax code it's called qualified small business stock, Section 1202. And I mean, just to give you an idea of the magnitude of the savings, you can exclude up to $10 million of capital gain or 10 times the basis of what you paid for the stock. Now, usually we're dealing with founders here where the basis is zero. So it's a $10 million exclusion, right?
Mm-hmm.
And different rules depending upon when you were issued the stock. And it's very fact specific. And you have to be a C corporation, and the issuance has to be from a C corporation. But if you meet these stringent requirements, and by the way, if you're cognizant of what those are in advance, is all the better because you can avoid tripping a wire that makes you non-qualified, then you've got this powerful benefit. And I mean, there is nothing else in the tax code that allows an exclusion. We can talk more later about a deferral of gain, but that's a lot different than an exclusion where it just comes off the table altogether. So just to caveat it, I mean, and I'm reading from a list here, but it has to be a C corporation. You have to have held the stock for at least 5 years. At no time prior to the issuance of the stock can the corporation have had more than 50 million in assets. So if you've had multiple rounds of seed funding, that can sometimes be a problem if you weren't there before those seed rounds. And then you have to be a qualified business. So there's certain types of businesses that are off the table, professional services, banks, farms, oil, gas, and mining, hospitality, real estate. But if you're any other kind of operating active business, generally this is going to be an option. And if you're a C corporation, I would strongly recommend that you pursue this option because it's just so powerful. I mean, it's amazing, and it's still out there, and we've not seen any talk of taking it away. So
that's good.
Yeah.
I think it's an important point, like exclusion versus deferral, right? That's huge. Talk about like what they can do, like again, starting earlier. What are the things that they might do to trip where they couldn't take advantage of this? Like, what are the cautionary things that,
well, I mean,
besides the things you just listed?
If you've ever been an S corporation, that can be a problem.
Okay.
And sometimes there's a lot of scrubbing that has to go into historic fact patterns. And so making sure you qualify, it can be exhaustive. I mean, if you're going to have a $10 million benefit, generally the service is going to want you to be all over it from a fact perspective, and they might challenge it. So we as a firm do these studies, and it can be exhaustive. And if you don't have good history going way back, like 20 years, we can't get comfortable that for sure you qualify. And it becomes especially problematic for the person preparing your personal tax return to be able to say for sure, yeah, this works. And I mean, if I wasn't 100% sure, I wouldn't sign a return taking that kind of a benefit. It's just too much risk. But that said, generally you can get there, and it's a slam dunk once you do.
Okay. Do you see many people sort of come to you and then have that in mind? Like, can they plan with the end in mind? Or is that like, can you be in the middle of a 20-year business and this works? Or do you need to plan for that? Like, from the get-go.
You can plan. I would say most taxpayers early in the life of their business are not that sophisticated.
Yeah.
So more often than not, it's, hey, I'm getting ready to sell. And we're like, oh, by the way, here's this section out there. Does your fact pattern qualify? And yes, it does. Now, that's not to say you couldn't plan. I mean, I think some folks might be sophisticated enough on the front end to know.
Yeah.
But it's, in my experience, in my professional practice, it's kind of like you either fall into it or you don't.
Got it.
Yeah.
Okay. So it's something you can take advantage of, and it's a major bonus, or dang it.
More or less. Yeah.
Yeah. Yeah. Find some good deferral vehicles, right?
Yeah. Yeah.
Yeah. Nice. Okay. That's great. I love that that's out there, and thanks for circling us back to that. Are there any other, before we go into sort of the buyer side, is there anything else that, you think is really pertinent for sellers to think about when they're selling their business?
We talked a little bit about sell side due diligence and issues that can arise. And I mean, I'll speak to tax issues that come up most frequently. Most of what I see is flow through businesses. So income tax is not a huge consideration on an exit. And most of the time, tax preparers know income tax. But I think where folks can kind of get, caught a little bit blindsided is issues like sales and use tax. So, sometimes folks will think, oh, I'm a service business. I don't need to worry about sales and use tax. Well, that's not always true. Certain jurisdictions are absolutely going to tax you for certain types of services. And there's rules that are different by each jurisdiction. So you need somebody well-versed in that. There's also issues with employment taxes, employment versus general contractor, 1099 versus W-2. That can be pretty costly, and sometimes is a nothing. Other times it can be a real big deal. And again, I would emphasize the importance of sell-side diligence. If you don't know these things are handled internally and there's any question, you can vet these out in advance of a sale.
And I'm assuming there's remedies for this if you find yourself, like, oh, I didn't, I had some 1099s versus W-2s and I should have paid taxes, or again, I'll let you use the words.
Yeah, no, I mean, on sales and use tax especially, there's a lot of states that have what's called a voluntary disclosure arrangement. And again, this is where 3 to 5 years out, you can go to state and say, hey, I'm non-compliant. I want to be compliant. And in a lot of cases, you can get there and you'll have to file back returns, but there's going to be some relief on penalties and interest.
Because you came to them, or because of time?
Right.
Nice.
Other times there might not be a valuation or a voluntary disclosure arrangement available, and you just kind of have to know, eyes wide open going into a deal, they're probably going to find this, and here's the exposure. So
and just own it. Don't hide it. Okay. So let's go to the buyer side, and the different types of buyers that come to the table, and how sellers might think about the advantages and disadvantages of each one.
Sure. So, I mean, I think in order, you can sell, there's numerous ways to transfer a business without doing a sale, right? I mean, you can transfer to, the successive generations of your family. You can do an ESOP transaction where you give the business over to your employees, basically. You can sell to a strategic buyer, which would be like another company in your same business. It might be another family-owned business, right? And then there's, I'll call it the nuclear option. I call it a great option, which is a private equity exit. I do a lot of work in this space, and I think there's a lot of misconceptions around it. And some people are just not going to be okay selling to private equity, and that's okay. Yeah. But I'd love to take an opportunity to kind of maybe dispel the boogeyman, so to speak.
Yes.
And so, I mean, I think private equity, sometimes people think of it and they think of that scene from Pretty Woman where Richard Gere comes in and
breaking it all down and crushing the family business. Yes.
Right. And there are shops out there that still do that. Although I would say most of what I've seen, actually all of what I've seen in practice, is more trying to create a creative value. So you would buy a founder-owned business typically, or somebody that's already owned by private equity, but let's start with a founder. And you would acquire a majority share. And then your goal would be to exit in 3 to 5 years at a higher multiple. And you're not going to get there by slicing and dicing. You're going to get there by growing and making more efficient the management team, add on acquisitions, complementary businesses, and really trying to through, synergies, come up with something that, the sum is greater than the parts. And
Mhm.
if it works out right, it's good for everybody. Now, not every deal sells for a higher multiple. I mean, there are dogs,
Yeah.
of course,
Yep.
but the ones that I've seen by and large are good for management, good for the founder, whether they exit entirely or whether they roll over, and we can talk about what that is.
Mhm.
And sometimes there's potential for multiple exits. It's a pretty powerful exit strategy, and I would say too, your multiples from a PE firm are generally going to be higher, assuming your financial books are in order. They're willing to pay a premium if you've got
Mhm.
something that they're looking for and think they can grow.
Yeah, one thing that I was not aware of when we talked before was the multiple exits
Mhm.
piece. If there's a lead into that, and not if I'm skipping over a bunch of things before we get there, feel free to fill in the blanks there. But I'm not sure everybody knows that there are ways to have multiple exits when you go with a PE firm.
Absolutely. Well, I mean, let's start with how you get there, and
Yeah.
it's called a rollover. And we talked earlier about a tax exclusion under 1202 qualified small business stock. Well, a rollover is a way to defer taxation. So let's say you want to sell your business and maybe you're willing to stay involved in the business or want to be a minority investor. So what you can do is you take some cash off the table and say, well, I'm going to roll those shares into the next one. So maybe it's 20%. And so you retain a 20% ownership. Now, usually the PE firm is going to want you to stay on, have some skin in the game, right?
Right.
So you'll stay on either as an employee or a contractor, help the business to go through its next phase. But then when it does, your 20% rollover equity is kind of dragged along into the next deal. And you can definitely have multiple exits. I mean, we've seen multiple $1 million payouts happen twice, sometimes three times with founder owned businesses because, I mean, in theory, your interests are going to be aligned with the PE firm if you choose wisely going into it, right?
Hmm.
It's going to
Hmm.
be accretive value, synergies, et cetera, and you're going to grow the business, sell at a higher multiple, certainly once, maybe twice. It depends and how long you
Yeah.
want to stay in the business. And I mean, and some folks don't want to roll over. I mean, some folks want to take all their chips and
Be done.
retire,
Right.
which is
Yeah.
fine.
Yeah. Yeah. Yeah.
But yeah, I mean, I think, inevitably, and we kind of touched on this, but with PE ownership, typically you're going to give up some control because they're going to
Hmm.
want majority. In less common circumstances, they will take on a minority interest, but generally they're going to want to call the shots. And you, as a founder, might have influence,
Yeah.
but you're not going to make the final decision. And
Yeah.
some folks are okay with that. Some folks definitely are not, and that's fine. You just kind of
Yeah.
have to know where you fall on that continuum.
It's true. I've also seen people who think they're okay with it and then find out they're not, right?
And we've seen that too, and it can
Yeah.
create some friction.
Yeah.
Um,
When you work with a lot of family businesses,
yes.
so do you think that is I guess I'm sure the answer is depends, but like you've got a family legacy and there's no child wants to take it over. The internal people don't want to take it over. So you're taking it to private equity.
Mhm.
Do you find that what's their experience for that? Is it a bigger mental, emotional hurdle for them to sell to private equity than maybe a non-family owned business, or it just varies?
It varies. I mean, I would say I've got some clients that are very much opposed to a private equity exit, and that's fine.
Mhm.
I mean, they've
Yeah.
got great reasons for that, and we respect that. Um, there's others that yes, I mean, it's like seeing their baby in the hands of somebody else. I mean, it's a tough emotional hurdle to
Yeah.
overcome, but ultimately it's a continuum of, do you want to take cash off the table or do you want to stay involved, and how long can you stay involved? I mean, sometimes it's
Mhm.
just not administratively practicable, or you're getting up there in age and you just can't.
Yeah.
And it absolutely is emotional, and we help clients navigate that all the time. And I mean, I like private equity because I do a lot of work in that space, but it's not for everybody.
Right.
And I totally understand if somebody, despite what anybody else might say, is just against the concept. I mean, that's
Yeah.
completely okay. And there are other options and strategies, and
Yeah.
we work with businesses of all types on all ends of the spectrum.
So you're leading me right into like some of the work that I do around the transition piece, and
Mhm.
that is an emotional process. And I love that you're mentioning as the CPA, who you think of as very much the numbers guy or the private equity deal maker, also having to deal with the emotions. Talk
Mhm.
a little bit about how you walk any of your clients through that decision. And let's focus it on the private equity, where it's like you're having the conversation, they're like, okay. And then they see their baby in the hands of somebody else. Cause like staying on sometimes could be harder than just letting it go, right? You get to see your baby dismantled, right?
Yeah.
Or changed. Maybe not dismantled, but changed.
I mean, I've got probably 3 examples. I've got, let's start with what I usually see is we have relationships with PE companies. They buy a business, and then we are sometimes the first step up in CPA, so to speak, versus who was handling their business before. They've come into a huge windfall, and they need to know, okay, I just did this deal. How does it get reported from a tax standpoint? And generally they've already overcome the emotional hurdle, and they're tickled pink that they've got a huge windfall, and that's what makes sure their ducks are in a row.
Right.
But I do have legacy family-owned businesses. One is just they don't like the concept of private equity, and that's completely okay. And they're looking at a whole host of options, from an ESOP transaction to maybe there's a family member that might want to take it over. And the gentlemen that run it are they're retirement age, but they're going to keep working, and they're just taking their time figuring out what they want to do, and that's fine.
Yeah.
I've got another business that again, family owned, and the owners there are fairly young, and again, PE opposed, which is fine. And they are kind of operating as a strategic buyer. So they're developing a pretty sizable portfolio of companies within a certain industry, but not private equity. I mean, it's capital developed from the operations of the business, some debt, but really trying to grow organically under that strategy. So it's a little bit like politics, right? You either love it or you don't love it.
Right.
From a PE perspective, and we work with all sides of it. We try to stay pretty agnostic. It's just listening to the needs and wants of the owners, and advising them as best we can in the construct of the financial and tax world that we live in.
Right, giving them the options, right, letting them know what the breadth and of the different options. And it sounds like because you know the private equity world pretty well, you probably have a good sense of who's going to be a fit and who's not going to be a fit potentially.
Yeah, and I do have to be careful, of course, to not let my it's a good analogy to politics again, not let my personal opinions come into it.
Yeah.
Because I mean, people feel strongly, and you can alienate folks pretty quickly if you don't stay cognizant of where they are on that spectrum of acceptance and willingness to talk to private equity. And again, it's absolutely fine. There's plenty of options if that's not the way you want to go.
Yeah. So just to wrap this up and bring it back up to the 30,000 or 10,000 foot view, if you are giving a business seller who's just starting to think about their business, selling their business, regardless of who they're selling it to, what's your 1 or 2 pieces of advice you would give them? Like, where do they start?
I'd say start with who you know, right? Start with your attorneys, your bankers, your CPAs, and say, here's what I'm thinking about doing. Who do you know? And I'd say, depending on the sophistication of your business, the size of your business, a good step may be to contact an investment banker who can kind of serve as your quarterback through this process. I mean, their primary goal in most cases is going to be to, market and sell your business. Some are going to try to do that as quickly as possible because their goal is to close a sale. Others are more, consultative and strategic in that. And you kind of want to find the right mix in an investment banker. But they can kind of quarterback the deal. They know folks in this space that can help if you don't. But I would say eyes wide open, ask around, and find people that are knowledgeable to help you do what you want to do on your terms.
Yeah. Great advice. Jason, if people want to find you, work with you, ask questions, how do they find you?
Sure. Easiest way is on Reuben Brown's website. So that's www.reubenbrown.com. And there's links to all the partners and industry groups on there. So
Perfect.
That's great. And then I'm also on LinkedIn. So I'm going to say happy to accept any and all requests. So we are a full service CPA firm, and any and all of the services outside of legal that I have mentioned on this call, we do in one way, shape, or form, including investment banking, believe it or not. So,
okay.
So happy to make any introductions.
Wonderful.
Yep.
Jason, thanks so much for your time. I appreciate it.
Sure, absolutely. Thank you.